Hello and welcome back to The Note, still coming to you this week from New York. Today we're going to take a look at flows of funds from US retail investors into the stock market. And according to my guest today, it looks as though we might have crossed quite a turning point. Inflows into stock funds in the US for this year are on course to be equal to the inflows they had received for all of the 4 previous years combined, apparently. So have we finally reached a point where US investors feel optimistic about the future? With me now to discuss this and many more is the co-founder and head of research at Strategic Insight here in Manhattan, Avi Nachmany. Avi, thank you very much for joining me today.
Thank you for having me.
Now, if we will start by taking a look at the overall picture for inflows into long-term funds, obviously divided also into active funds versus passive and ETFs. What is driving, first of all, this move back into the market and also the tendency to do that through passive vehicles rather than active?
Well, let's start with the realization that 2013 and 2012 were transition year from the experience that investors have had for the last 4 or 5 years. And this year, just for clarification, stock and balanced mutual funds in the US and ETFs will attract about $450 billion, which is more than the last 4 years combined. So clearly investors are stepping out of this sense of uncertainty in the future that they have lived through for a while and are investing for the future in the US, globally, emerging, developed market, in a wide range of strategy. We are finally out of the mud. Maybe for now.
Okay, so we've climbed the wall of worry. Why are people so interested in passive compared to previous years? There's quite a dramatic shift away from active and towards passive.
Well, we have seen transition to passive for a while, and much of that transition also is absorbed by exchange-traded funds, ETFs, that are used by individual investors as well as institutions. There are ETFs, index funds have certain advantages. They're also increasingly adopted in asset allocation strategies, which are becoming the way to invest for the great majority of investors in the US.
Okay, and we have a chart to demonstrate that as well. It's really quite startling. When you invest with an advisor, you really invest as part of an asset allocation program. Why is that so popular? Have people decided after 2 crashes that they really can't do their own asset allocation?
The world is so interconnected and so uncertain.
Right.
And we're all so busy to manage our life that we say, I need to outsource the selection, rebalancing, portfolio construction, and adjustment in good and bad days. And that transfer of allocation and portfolio construction is very consistent and it's very secular, and it's not going to change.
Now, what's interesting there, therefore, so you almost have an automatic stabilizing mechanism where people aren't going to make dramatic switches between bonds and equities. What's interesting is that at the beginning of this year, there was all this discussion about a possible great rotation out of bonds, which obviously looked historically expensive, into equities. If we look at the figures for sales of bond funds compared to equities, yes, they're down a bit, but there's certainly nothing you would call a great rotation. Do you believe there is anything we can meaningfully call a great rotation?
Well, there are many dimensions to this situation. First of all, if you invest in an asset allocation strategy, whether rates are going to decline or are stable or may increase, you still put 30, 40, or 50% of your portfolio in some bond strategy. And that's actually what we see in the data. I also think that we continue to see rotations that are in 2 areas.
Right.
One is rotation into stocks, and the other rotation is from uninvested cash in the banking system. There are more than $10 billion in the US uninvested in cash. And that rotation
I think you meant 10 trillion.
10 trillion, yeah. 10 trillion, and clearly multiples of that globally. And that ocean of money is searching for income and safety solution, and that money is transitioned to bond and fixed income strategies still. So there's rotation into stocks and rotation from uninvested cash to invested cash into bond funds. So added up, it's not surprised that still about 40% of US fund sales, which is in excess of $1 trillion. In the US, you see sales of bond funds next year too.
Okay, Avi, thank you very much indeed. I think that's a fascinating oversight of the fund management industry, and I think the critical points are, yes, we do have reasons to be positive. It's obvious that animal spirits are encouraging, and also perhaps compared with the last time animal spirits really got improved in the 90s, it looks as though people are doing this in a somewhat more prudent way than they did back then. That, I think, is to be welcomed.